Listen carefully. Imagine standing on a solid concrete floor, confident it will hold your weight, unaware that deep underneath, the foundation has already cracked. From the surface, everything looks fine. The walls are standing, the lights are on, but the stress fractures are spreading silently, and the moment you shift your weight, gravity takes over. There is no warning, no gradual failure, just collapse. That is exactly where the silver market is right now, and most people watching price charts have absolutely no idea what just snapped. Oh, you're not supposed to see this yet. In fact, the system is designed so that you don't see it until it's too late. Headlines will tell you silver is volatile. Analysts will debate inflation, interest rates, sentiment. None of that explains what actually happened, because what broke the silver market didn't happen on a chart. It happened underneath it, and the institutions know it. They are already reacting. Retail investors are still staring at candles, wondering why price doesn't make sense anymore. Something critical has already shifted. Not gradually, not hypothetically, structurally. And once you understand what that shift is, you stop asking whether silver will move and start asking how violent the adjustment will be. Now let me slow this down, because this is not hype and this is not rumor. This is not a prediction. This is not opinion. This is mechanics. And mechanics don't care how bullish or bearish you feel. They don't care about narratives. They don't care about optimism. They only care about pressure, leverage, and what happens when a system promises more than it can physically deliver. The reason most people are confused right now is because they're being shown the wrong signal. Price is the last thing to react. By the time price reflects reality, positioning has already changed, inventory has already moved, and institutions have already protected themselves. Headlines are always late. Charts are reactive. What matters is flow. What matters is access. What matters is who can still get the metal when they actually need it. And that's where China comes in. For years, the silver market has operated on a quiet assumption that no one really questions. That assumption is simple. No matter how much paper silver is traded, no matter how large the futures market grows, physical silver will always be available somewhere in the world at a small premium. That assumption is the floor beneath the entire system. It's the unspoken agreement that allows leverage to exist at all. That floor just cracked. China didn't announce it with flashing lights. There was no dramatic press conference, no emergency broadcast. But what they did was far more decisive than words. They changed access, they changed flow, they changed who gets metal and who doesn't. And the moment that happened, the paper market stopped representing reality. Here's the part most people don't understand. The silver market is not one market. It is two markets layered on top of each other. One is fast, liquid, and abstract. The paper market, futures, options, ETFs, swaps, numbers moving on screens, contracts promising delivery at some point in the future. The other market is slow, physical, and unforgiving. The real world. Bars, inventory, refining, shipping, industrial use. As long as those two markets stay loosely connected, price discovery works. But the connection is fragile. It depends on logistics, cooperation, and access. When that connection weakens, price stops being a signal and starts being a lie. China controls a massive portion of the world's silver refining and processing capacity. That doesn't mean they mine all the silver, but it means a huge amount of global silver flows through Chinese infrastructure before it ever reaches end users. For decades, that flow was assumed. It was treated like gravity, always there, always reliable. No one built the paper market to survive without it. When China restricted that flow, they didn't just tighten supply, they changed the rules of the game. Now let's talk about why this matters in real terms, not abstract theory. The futures market is built on leverage. That's not a criticism, it's a design feature. One contract controls a large amount of silver with a relatively small amount of capital. That leverage only works if delivery is mostly theoretical. Most contracts are never settled with metal. They're rolled, closed, or cash settled. That's fine, until suddenly more participants want the option of physical delivery at the same time. Why would that happen? Because when real-world supply tightens, industrial users don't care about paper profits. They care about keeping factories running. They care about inventory. They care about certainty. This is where forced behavior enters the system. When physical silver becomes harder to source through normal channels, buyers don't wait. They don't negotiate politely. They secure supply wherever they can. That means pulling metal forward. That means demanding delivery instead of rolling contracts. That means draining inventories that were never meant to be tested. The silver market does not break when price goes up. It breaks when delivery expectations change. Now layer leverage on top of that. When leverage is high, small moves cause big reactions. When margins change, behavior changes instantly. Not because traders change their minds, but because they have no choice. Forced selling is not bearish opinion. It is mechanical liquidation. It happens regardless of fundamentals, regardless of conviction. This is why recent volatility has felt unnatural. Sharp spikes, sudden drops, violent reversals, that's not normal trend behavior. That's pressure release. That's a system trying to rebalance positioning under stress. Think of it like a pressure valve. For years, pressure built quietly. More contracts, more leverage, more promises. As long as physical supply flowed freely, the valve stayed shut. The moment supply tightened, pressure had nowhere to go. So the system did what it always does. It tried to shake out weak hands. It tried to flush leverage. It tried to scare participants into reducing exposure so that the imbalance wouldn't become obvious. That's not random. That's intentional behavior. Institutions understand this dynamic very well. They don't panic when price collapses for a few hours. They look at why it collapsed. They look at who was forced to sell. They look at whether the selling was discretionary or mechanical. Retail investors often make the mistake of thinking that violent price action equals new information. In reality, violent price action often means old leverage being unwound. Now, here's the uncomfortable part. The silver market cannot resolve this quietly. It cannot drift sideways indefinitely. It cannot smooth this over with commentary. Either physical supply loosens again, or price must rise enough to ration demand and incentivize new supply. There is no third option. And when I say rise, I don't mean in a straight line. I mean through volatility, through spikes and air pockets, through moves that feel irrational in both directions. This is why focusing on short-term predictions is useless. Right now, the question is not up or down tomorrow. The question is whether the structure can support current pricing given the change in physical access. Paper markets hate uncertainty. Physical markets don't care. If metal isn't available, the status nyrgi, the price, eventually that truth forces itself into the paper layer. Now let's talk about escalation, because this is where most people underestimate what happens next. When pressure persists, institutions don't sit and hope. They change rules, they adjust margins, they modify settlement terms, they protect the system first, participants second. This has happened before. It will happen again. Margin requirements can rise, position limits can tighten, cash settlement can be encouraged or forced. These are not signs of a healthy market. They are signs of stress management. Every one of those actions increases volatility. Every one of them forces behavior. Every one of them transfers assets from those who can't respond quickly to those who can. That's why volatility clusters exist. Once they start, they feed on themselves until enough leverage is gone. But here's the critical distinction. Flushing leverage does not create silver. It only changes who holds exposure. If industrial demand remains and physical supply remains constrained, flushing leverage only delays repricing. It doesn't prevent it. This is where risk balance matters. There are real risks that can change the path: policy shifts, diplomatic adjustments, central bank interventions, a sudden global slowdown that reduces industrial demand temporarily. Those things matter. They can delay, they can soften, they can redirect, but they do not erase the fundamental mismatch between promises and availability. That's why this setup is high probability, not certainty. High probability does not mean smooth. It does not mean fast. It does not mean comfortable. It means the path of least resistance eventually changes direction. So what should you actually watch? Not predictions, not targets shouted on social media. Behavior. Watch how price reacts to stress, not calm. Watch whether sell-offs are met with immediate buying or indifference. Watch whether volatility compresses or expands. Watch inventory reports, delivery demand, and how premiums behave in the real world. When price drops but physical premiums don't, that's a signal. When price spikes but open interest falls, that's a signal. When rules change quietly, that's a signal. Stay calm. This environment punishes emotional reactions. It rewards patience and understanding. If this breakdown helped you see The structure, instead of just the noise, share it. Most people are still staring at the surface, unaware the foundation has shifted. And if you want to stay ahead of how this unfolds, subscribe. Not for hype, for clarity. Because once the floor gives way, the move is never subtle. If you thought the first part was intense, wait until you understand the numbers, the structural mismatch, and the data that the mainstream does not emphasize. What's happening right now in the silver market isn't a typical rally, a speculative bubble, or a momentary squeeze. It's a structural fracture, a disconnect between physical metal availability and paper pricing that has never been this wide at a global scale. And today's data proves it. First, let's anchor you in reality. The global silver market is still showing huge volatility on paper, but the physical market behavior is far stronger, far more meaningful, and far more urgent than what the COMEX ticker suggests. On many Western exchanges, the paper price of silver, the one you see quoted around 70-75 per ounce, is only part of the story. In major physical trading hubs like Tokyo, Dubai, and Shanghai, physical bullion is reportedly exchanging hands at significant premiums, in some cases as high as 80-100% more than the COMEX price. When price drops but physical premiums don't, that's a signal. When price spikes but open interest falls, that's a signal. When rules change quietly, that's a signal. Stay calm. This environment punishes emotional reactions. It rewards patience and understanding. If this breakdown helped you see the structure instead of just the noise, share it. Most people are still staring at the surface, unaware the foundation has shifted. And if you want to stay ahead of how this unfolds, subscribe. Not for hype, for clarity. Because once the floor gives way, the move is never subtle. What that tells you is simple. The paper market is still acting like there's enough metal, but the real challenge, the real signal, is in the physical premium, which reflects what people actually need to deliver and take possession of metal, not just bet on a number. In a functional market, the premium between markets would collapse quickly as arbitrageurs exploit it. But when that premium persists, and especially at double-digit levels, it means the physical metal is genuinely scarce where it matters. Now let's bring the supply and demand data into full focus, because this is where the structural story becomes undeniable. According to multiple market reports, the global silver market has been running in a structural deficit, meaning demand exceeds supply, for multiple consecutive years. One analysis pegs 2025 demand at around 1.24 billion ounces, while total supply was roughly 1.01 billion ounces, implying a shortfall in the range of 250 million ounces. This kind of persistent deficit doesn't correct itself in a quarter or a year. It compounds. And when the primary source of exports, China, restricts supply further, that deficit accelerates dramatically. Here's where China's role becomes mission critical. Effective January 1st, 2026, China introduced a new silver export licensing regime requiring government-approved licenses to ship silver internationally. Only large, state-certified producers qualify. Smaller refiners, which historically accounted for a substantial share of exportable metal, are now effectively sidelined by regulation. China controls approximately 60-70% of the world's refined silver supply, so when its export regime changes, it changes global supply availability overnight. The export licensing regime isn't just a bureaucratic hurdle. It's a bottleneck that dramatically reduces the amount of real metal that can flow to the Western market, just as the rest of the world was already struggling to meet industrial demand. That's no longer a theoretical issue. It's a real disruption embedded into the physical market mechanics. Think of supply like a water pipe. For years it flowed freely. Now, overnight, you've had 3/4 of that pipe shut down with a bureaucratic valve. That's what's destabilizing the market. But let's bring another number into this discussion that cuts even deeper. Inventory levels. COMEX registered inventories, that is, the metal that is actually available for delivery against futures contracts, have declined more than 70% since 2020. London vaults have also seen significant drawdowns, and Shanghai inventories sit near decade lows. Those inventory drops are not seasonal. They are structural, a sign that supply is being drawn down faster than it can be replenished. Meanwhile, industrial demand, from solar panels to electronics to electric vehicles, continues to rise. Physical demand doesn't disappear overnight when prices shift. If anything, constrained markets accelerate physical procurement, not reduce it. Now compare that to the paper market. COMEX prices remain lower because the exchange is still dominated by speculative flows, technical trading, paper contracts, and margin-driven behavior. Those participants dominate the visible price. But the Neidszeitung, they don't represent the way the real metal flows. When people need actual ounces for production, not just price fluctuations, they pay premiums. And those premiums have been breaking historical norms. In Shanghai, for example, the divergence between physical delivered prices and COMEX futures has been tens of dollars per ounce, more than double what normal arbitrage would justify. That tells you that buyers in markets where delivery matters are willing to pay significantly more than the price seen on Western screens. That's the real market speaking. Another critical piece of data to understand is the paper to physical ratio in silver markets. In an efficiently functioning market, paper claims, futures, ETFs, contracts, should be loosely tethered to actual physical stock. But according to some market analysis, that ratio has ballooned to levels like 356.1, meaning for every ounce of real deliverable silver, there are hundreds of paper claims. That kind of disconnect is not normal. It's not sustainable. It's a structural imbalance waiting for a catalyst, and China's export changes were that catalyst. But data isn't just about deficits and ratios. Let's look at price behavior, because that's what most retail investors focus on. Throughout 2025, silver posted a stunning rally. It was up over 150% on the year, driven by both investment demand and supply concerns. The metal briefly broke into the mid-80s per ounce before a sharp correction knocked it back into the low 70s. But here's the nuance. Those corrections often happen in the paper layer when exchanges raise margins or technical traders book profits. They don't necessarily indicate that the underlying physical shortage has eased. In fact, one of the largest corrections in late December was driven by a series of margin hikes by the CME group aimed at risk control, not because supplies suddenly improved. It's vital to understand how margin hikes work in leveraged markets. When margin requirements increase, leveraged long positions are forced to post more collateral or close positions to avoid liquidation. In a market already under stress, that kind of move can trigger forced selling, not because the physical story changed, but because the paper market mechanics demand it. And in silver, we saw that happen just as physical supply constraints were tightening, a dynamic that has created psychological confusion but not resolved the structural gap. Equally important is the global context. Industrial demand for silver is growing. Solar panel manufacturing, for example, accounts for significant annual demand. Electronics and EV battery production add even more. These aren't speculative uses. They are real industrial consumption where metal isn't optional. To meet this demand, buyers need metal delivered physically, not just priced on a screen. And as inventories tighten, those buyers are being forced into bidding wars at premiums far above the futures price. This is where the silver market begins to resemble a pressure cooker, not a simple supply and demand chart. On one side, you have the paper market, futures, ETFs, derivatives, dominated by leverage, margin trading, and technical flows. On the other, you have the physical market, manufacturers, refiners, end users, where metal is consumed, not traded. When those two sides diverge sharply, the market doesn't settle quietly. The divergence resolves. And history shows that resolution is never linear. Look back at historical precedents. Structural mismatches in markets like silver don't fix themselves through complacency. They either unwind violently or they reorganize under a new equilibrium. When COMEX inventories were stressed in past cycles, the exchange responded by adjusting rules, raising margins, and tightening access. That may stabilize the paper market momentarily, but it doesn't replenish metal. Meanwhile, physical markets continue tightening, inventories continue drawing down, and premiums continue rising. Over time, buyers shift their behavior. They start prioritizing delivery certainty over price speculation. When that shift happens en masse, the paper price becomes a lagging indicator, not a leading one. The premium becomes the real price. And when investors, industrial buyers, and institutions all start acting based on physical availability instead of paper pricing, the game changes. This is not a small theoretical risk. It is precisely what commodity markets move toward when real scarcity confronts a leveraged paper system. Compound that with China's new export regime, requiring government licenses for exporters effectively silences a large share of China's refined silver output in global trade. Only large state-backed producers will qualify, leaving mid-sized and smaller refiners unable to export. China, which dominates refining capacity, is reallocating silver toward its own industrial base at the same time that Western markets are trying to import it. This isn't a temporary policy tweak. It's a structural realignment. If you think about exports like water flow between two regions, imagine a dam suddenly built upstream. The downstream markets, which had been consuming based on the assumption of steady inflow, suddenly find that assumption invalid. Induced scarcity doesn't wait for price signals. It waits for real deliveries to dry up. This is a game changer. Now, every buyer who thought they could roll contracts indefinitely begins questioning whether those contracts will ever convert into metal. So that's an existential shift in market psychology, and psychology matters, especially in markets built on trust and delivery assurance. There's another piece of data that underscores how big this shift could be. Some analysts suggest that physical prices, not just paper quotes, could reach triple-digit levels, potentially pushing toward $125 per ounce or beyond if shortages intensify and delivery demand rises sharply. Those are not fringe forecasts. They're rooted in the mechanics of supply constraints, premium expansion, and the physical scarcity shock. But let's be clear, numbers like $125 per ounce aren't a guarantee. They're outcomes that become more probable when structural gaps widen and resolution becomes inevitable. If you step back and connect all the dots, inventory drawdowns, export restrictions, industrial demand growth, margin hikes, price divergence, and premium spikes, you see a market under strain, not equilibrium, and strain doesn't resolve quietly. That's why the situation does not end with a simple bounce or correction. It ends with a repricing of the entire structure, a shift where physical scarcity can no longer be ignored, and paper pricing must eventually reckon with reality. As industrial buyers increasingly compete for real metal, they will drive physical premiums higher, and that pressure will eventually bleed into futures pricing. When enough of the market begins prioritizing delivery certainty over leveraged speculation, the disconnect collapses, sometimes violently. This is why institutions position early. They don't wait for price consensus. They read the physical flows, inventory levels, policy shifts, and risk structures. They don't react to headlines. They react to access and delivery risk. And China's export restrictions, backed by government policy, is one of the clearest structural shifts we've seen in decades. In the end, markets converge on reality. It's only a matter of when, not if. The paper-silver market can mask the truth for a while, but physical scarcity inevitably asserts itself through premiums, delivery behavior, and the shifting incentives of industrial users. That's why this moment is not just another volatility episode. This is a structural break, a fracture in the foundation of how silver has been priced for years, and understanding that distinction is the difference between reacting late and recognizing the shift before it becomes undeniable. At this stage, the silver market stops behaving like a market and starts behaving like a system under stress, and there's a critical difference between those two states that most people don't understand. In a normal market, price moves to balance buyers and sellers. In a stress system, price moves to manage damage. The goal is no longer discovery, it's containment. This is where things get uncomfortable, because when containment becomes the priority, transparency disappears. Let's talk about delivery, not as a concept, but as a process. When a futures contract approaches expiration, holders are given a choice. Roll it forward, settle in cash, or stand for delivery. For decades, the system has relied on the assumption that very few participants would ever choose the third option. And that assumption held not because delivery was impossible, but because supply was flexible enough that it didn't matter. That flexibility is gone. When physical supply tightens, the behavior of contract holders changes. Suddenly, delivery becomes valuable, not because of speculation, but because certainty becomes scarce. And when certainty becomes scarce, those who actually need the metal stop playing games. This is the moment where the paper market faces a dilemma it was never designed to solve, because if too many participants stand for delivery at the same time, the system has to choose who gets metal and who doesn't. And that choice is never neutral. It always favors the largest players, the most connected players, and the institutions that sit closest to the rulebook. This is why rule changes matter more than headlines. When margin requirements rise suddenly, it's not about protecting traders, it's about forcing behavior. Margin hikes selectively remove participants who can't add capital quickly. They reduce the number of contracts standing for delivery. They thin the field. When settlement rules are adjusted, when cash settlement becomes encouraged, it's not because cash is better than metal, it's because metal is scarce, and scarcity is the one thing a paper system cannot tolerate. Here's the part that makes people uncomfortable, but it's essential to understand. The exchange is not there to guarantee your metal. It's there to ensure the continuity of the market. Those are not the same objective. When those objectives conflict, Continuity always wins. We've seen this before. Whenever physical delivery threatens to expose leverage, the response is never to let the system break cleanly. The response is to bend the rules just enough to survive. Sometimes that means margin hikes. Sometimes it means position limits. Sometimes it means emergency settlements. Sometimes it means redefining what delivery even means. These actions don't solve the problem. They delay it. They redistribute it. They move it from public view to private balance sheets. And while that happens, institutions reposition. This is the most important behavioral tell in the entire market. Institutions don't argue publicly. They don't explain themselves. They move quietly. They reduce risk where delivery is uncertain. They increase exposure where scarcity benefits them. And they do it before the narrative shifts. Retail investors often look at institutional positioning after the fact and assume it was reactive. It rarely is. By the time a position shows up in public data, the thinking behind it happened months earlier. This is why price confusion increases during periods like this, because two groups are operating under two different realities. One group is still trading silver as a liquid financial asset. The other is preparing for it to behave like a scarce industrial input. Those two views cannot coexist indefinitely. Eventually, one wins. Now let's talk about psychology, because this is where most people lose. Volatility doesn't just move price, it attacks confidence. Sharp drops make people doubt their thesis. Sharp rallies make people chase. The system thrives on this emotional instability because it shakes out participants who don't understand what they're holding. If you only understand silver as a chart, volatility feels like chaos. If you understand silver as a supply chain, volatility feels like signal. Every violent move is information. A sudden drop on no news is often leverage unwinding. A sudden rally with weak participation is often short covering. A rally with strong volume and shrinking availability is something else entirely. The mistake most people make is assuming that price must make sense every day. It doesn't. Price only makes sense over the full cycle. And cycles don't care about your entry point. This is why timing the exact top or bottom is a distraction. What matters is whether the structure supports the current price. Right now, that structure is under strain, and strain does not resolve sideways forever. There are only three ways this ends. The first is demand destruction. Prices rise enough that some users are forced to reduce consumption, substitute materials, or delay production. This takes time and causes economic pain. It doesn't happen quietly. The second is supply response. Higher prices incentivize recycling, exploration, and alternative sourcing. This also takes time. Mines don't appear overnight. Refining capacity doesn't expand instantly. The third is system intervention. Rules change, markets are segmented, delivery is restricted, paper and physical decouple more openly. None of these outcomes are smooth. None of them are painless. And all of them involve volatility that feels irrational until you understand what's being rationed. What's being rationed is not silver. It's certainty. The moment certainty disappears, everyone behaves differently. Industrial buyers stop trusting just-in-time delivery. They hoard. They secure long-term contracts. They bypass exchanges. Investors stop trusting paper claims. They demand allocation. They demand clarity. And the system responds the only way it can, by slowing everything down and forcing participants to choose. This is why staying calm matters so much right now. Emotional decisions are exactly what volatility is designed to provoke. The system doesn't need everyone to panic. It only needs enough people to act irrationally to reduce pressure. The irony is that the people who understand this best are often the least vocal. They don't post charts every day. They don't chase moves. They watch behavior, not noise. They understand that when the foundation cracks, the loudest signals come last. So here's what you should be watching. Not as predictions, but as confirmation. Watch whether physical availability continues to tighten even when price pulls back. Watch whether delivery timelines extend further. Watch whether volatility increases without corresponding news. Watch whether rules change quietly while narratives stay calm. Those are the tells, because when the system finally acknowledges what the physical market already knows, the adjustment doesn't ask for permission. It just happens. If you've stayed with me this far, it means you're not here for entertainment. You're here to understand the structure beneath the noise. Share this with someone who's still confused by the price action, and stay subscribed, because the next phase of this market will punish those who react emotionally and reward those who understand what's really being rationed. The chair hasn't collapsed yet, but the weight is shifting.